Overseas capital is, as far as I'm concerned, here to stay. The proportion of the market which is overseas in origin has been increasing over the last 2 years, and last year, of the 5.9 billion we saw invested in the West End, broadly 60% of that capital was from overseas, and it was spread across from different geographical regions. I mean, we saw broadly 25% of the market being European last year, 10% being US, and roughly 20% being Asian. And that is private investors and institutional investors. And we're continuing to see increasing sums of capital from Asia. We're seeing deregulation in certain markets across Asia, notably China and more recently Taiwan, where allocations for real estate, global real estate, are significant. And a large proportion of that will be heading to London as probably its first port of call, and then followed by other global markets. But London is the most sought after market for overseas capital. We all know the reasons for that. It's liquidity, it's the transparency of investing here, and investors feel very comfortable with the structures we have in place. Other markets provide less transparency, such as Paris, for example, or more fiscal or tax issues such as New York, which runs broadly even with Paris and London. So I think we will continue to see capital here. The reason it might go elsewhere is it can't find the product. And what we're finding is that overseas capital has longer holding duration, so it holds its property for longer. Therefore, we might not see the level of trading which London has been fortunate enough to have seen over the last few years, and we might not be able to provide the stock that overseas investors are looking to invest in. So it's really a case of, are we going to have the levels of stock that we've seen over the last 2 years in 2013, 2014, 2015? My view is we probably won't have quite as much, but we'll still have a very dominant overseas market in London. I think disconnected is probably the wrong word to use. The leasing markets across central London have had a quieter year. In the West End last year we saw about 2.5 million square feet taken up, which is below the long-term average, which is about 3.2 million square feet. What we do have is low levels of supply in Grade A supply. Our vacancy rate in Grade A across the West End is now about 3%. Which by historic standards is very low indeed. And coupled with that, we are seeing still low levels of development, and development is not creating that supply for take-up. What we haven't seen this year across the West End leasing markets is an uptick in demand. The TMT sector is buoyant at the moment, and we're seeing a lot of activity from media publishing, digital media, for example. And that is a sector which is going to continue to be very active, I think, in 2013. But generally, the wider sectors of the West End, business services being probably the most important, have had a fairly quiet year. Now, do investors worry about this? Not really. And overseas capital is looking for stability, long-term income, quality of build. I think we're going through a blip. Demand will increase and has to as the wider economy improves, particularly in London, which will lead the way out of the recession we saw in 2012. Is there a decoupling? I don't think so. But as long as we have vacancy rates which are low, and they stay low at 3%, and demand is there, albeit we're not seeing it in strong form at the moment, I don't think that really impacts too heavily on investors' decisions to invest in the capital.